Miroslav Volf said that, in a way, fraud in business is no different than infidelity in marriage or plagiarism in scholarly work. Hello and welcome back to Exploring Finance with Prashant. I am thrilled to have you here as we continue our exciting journey in the world of financial shenanigans. In the previous episode, we dived into the consequences of not reporting all the expenses dealing with taxes and financial reports. In this episode, we are going to discuss how management, under certain circumstances, might choose to deflate current period profits and shift them to later period. Sounds strange, right? Which type of management would do that? And most importantly, why? Well, I give you my reasonable assurance that the answer will be clear by the end of this episode. Imagine that a company is growing really fast and don't know what the future holds, or think about a company that you just got a big pile of money or a new huge deal. Investors definitely want to see those impressive numbers, but they also expect the company to do just as well or even better in the future. This can be pretty challenging for the company's leaders. They might feel like they have to use some strategies to delay reporting their income to a later time to keep up with these high expectations. In this episode, we are going to discuss four techniques about how management reduce the current year profits. The first method is about setting aside the money as reserves and then adding it to the earnings in the future. When a company is doing really well and making more money than expected by the analysts, they might be tempted to not show all their earnings right away. Instead, they might keep some of it safe for when they might need in the future in the form of reserves, such as the unearned reserves or retained earnings. Let us go through with an example. During the late 1990s, software giant Microsoft faced enormous scrutiny over its alleged anti-competitive practices by both US Department of Justice and European Union counterpart overseeing antitrust regulations. Presumably, the last thing Microsoft wanted to showcase was skyrocketing revenues and profits, as this would be become fodder for regulators. It certainly would have been tempting for the company to delay recognition of certain revenue by deferring it to a later period and storing it on the balance sheet in the form of unearned revenue. Microsoft's unearned revenue account grew by hundreds of millions of dollars every quarter from March 1998 to March 1999. Indeed, this reserve more than doubled over this period from $2 billion at the beginning to $4.2 billion at the end of March 1999. Then suddenly the growth subsided in the June 1999 quarter, with the company adding only as much unearned revenue as it was using. Well, it's one of the many theories applied on why Microsoft tried to unload the unearned reserve. In reality, not many companies experience consistent and strong growth that enable them to comfortably save billions of dollars in revenue earned and for future profits while still meeting the financial expectations of the Wall Street. Here, I would like to read out an excerpt of the Microsoft's 10K report of 1999, quote unquote. Upon the adoption of the SOP 98-9 during the fourth quarter of the fiscal 1999, the company was required to change the methodology of attributing the fair value to undelivered elements. Okay, before I go on reading, what is SOP 9-9, 98-9? Well, it stands for Statement of Position 98-9, which was issued by the American Institute of Certified Public Accountants. It is titled Modification of SOP 97-2 Software Recognition software revenue recognition with respect to certain transactions. So it's basically a modified version of the existing SOP 97-2, and it provides guidance on how revenue recognition is to be done for software related transactions. This statement of position was issued to address specific issues related to software revenue recognition and to clarify the accounting practices in the software industry. Now let's get back to the report. The percentages of the undelivered elements in the relation to the total arrangement decreased, the reducing the amount of Windows and Office revenue treated as unearned and increasing the amount of revenue recognized upon shipment. The percentage of revenue ratably decreased from a range of 20% to 35% to a range of approximately 15 to 25% of the Windows desktop operating system. For desktop applications, the percentage decreased from approximately 20% to a range of approximately 10 to 20%. The range depends on the terms and conditions of the license and the prices of the elements. The impact of fiscal 1999 was to increase the reported revenue by $170 million. Another example is the most famous company, which we have probably discussed in the previous episodes, Enron. Its infamous manipulation of the California energy markets in 2000-2001 earned the company huge windfall profits in its trading division. The profits were so large that the management decided to save some for the future quarters, which, according to the SEC, was done to quote unquote mask the extent and the volatility of its windfall trading profits. Now, compared with the rest of the Enron's manipulation, this scheme was straightforward. Simply defer some of the gains by storing it on the reserve in the on balance sheet, and these reserves come in handy and help Enron avoid reporting large losses during some difficult periods. Many companies like to make their income look steady and predictable because that's what market likes. But sometimes they use a trick called as income smoothing, where they move some of their money from now to later. This can be just as misleading as counting money too early. In both cases, it makes their financial results look different from reality. When they count money too soon, they are including future earnings for the current profit. With income smoothing, they are pushing some of the money they earned now into a later time. So, what did we learn from this first technique? First, changes in revenue recognition methodologies can lead to substantial shift in the reporting earnings as seen in the case of Microsoft. Second, Enron's infamous manipulation of the energy market involved storing windfall profits in reserves to mask volatility and avoid reporting the large losses. This practice highlights how companies may use reserves to manipulate the financial results. Third, companies may delay recognizing some of their earnings by creating reserves like unearned revenue to make their profit appear more stable. This practice can be tempting, especially when a company is performing exceptionally well and wants to avoid regulatory attention. Let's move to the second technique, that is making income look steady by mishandling the accounting for derivatives. Even successful companies can try to make their profit look steady by using tricks, like what happened with the mortgage giant Federal Home Loan Mortgage Corporation, also known as Freddie Mac. They wanted their earnings to appear consistent even when the interest rates were changing a lot. But they went too far and ended up involved in a $5 billion fraud scandal. From 2000 to 2002, Freddie Mac understated its earnings by nearly $4.5 billion. They reported strong earning growth in 2001 and 2002, but in reality, the earnings have been highly volatile during that time. So, why did Freddie Mac do this? Well, Wall Street expected steady and predictable earnings from them. In 2000, a new accounting rule, SFAS 133, created a lot of ups and downs in their investments involving derivatives. Management saw that this change would bring in millions of billions of dollars in unexpected gains. To most companies, this would be great news, but not to Freddie Mac. Their stock price relied on their reputation for stability, earnings, and that is why they had a nickname, Steady Freddy. So they decided to hold back some of these gains and release them later to make their earnings look smooth. Unlike the scandals at companies like Enron and WorldCom, Freddie Mac's goal wasn't to hide a failing business. Instead, they wanted to maintain their image as a reliable profit maker. In other words, their aim was not to create earnings out of thin air, but to make their earnings appear more predictable. Both type of practices break the accounting rules and mislead investors. The key difference is that companies like Freddie Mac are usually healthy ones trying to show a more consistent stream of earnings. Now let's shift our focus to another well-known case involving General Electric, GE. Like the many large companies, GE issued short-term debt called commercial paper with variable interest rates. To protect themselves from the risk of fluctuating interest rate, GE used the derivative agreements called interest rate swaps. These swaps were meant to make the variable interest rate payments more predictable by exchanging them for fixed payments. In late 2002, a problem arose when it seemed that GE had entered into too many swaps, essentially over-hedging their commercial paper interest risk. According to accounting rules, this excess hedging would be considered ineffective, meaning that changes in the value of these derivatives would affect the earnings of the company. GE realized they might have to record a $200 million charge because of these ineffective hedges. Throughout the December 2002 quarter, GE worked frantically to avoid recording this charge. Then, in early June 2003, just days before they were to report their earnings, they come up with a completely new accounting method for these hedges, one that produced the desired results. The auditors approved it, and GE managed to maintain its streak of meeting Wall Street estimates. However, there was one significant problem that this new approach followed by GE violated the gap. Now, it's essential for investors to keep an eye out when a company reports substantial gain from its hedging activities. These gains might seem impressive, but they can actually be a cause for concern. These so-called ineffective or economic hedges could in reality be risky speculative trading actions that might result in substantial losses in the future. Let's take a look at a case in point. Washington Mutual Inc. WAMU. They had a history of reporting significant gain from activities they labeled as hedges. In 2004, the company announced the gains of $1.6 billion, which they classified as economic hedges. But at the same time, they had a $500 million loss from their unhedged MSR. MSR stands for Mortgage Servicing Rights Asset. In simple terms, WAMU's hedging activities seem to produce gain 3 times the size of the underlying loss. So what are the takeaway from this technique? First, financial smoothing. Companies manipulate their financial reports to present a facade of steady earnings even during turbulent economic periods. This practice can mislead investors and violate the accounting standards. Second, vigilance is vital. Investors should remain vigilant and critical when analyzing a company's financial performance, especially when large gain from hedging and accounting maneuvers are reported. Scrutinizing financial reports is essential to make informed investment choices. Third, management's motivation. Understanding why companies engage in these practices is crucial. In some cases, it's not about hiding a failing business, but maintaining an image of reliability to meet investor expectation. Now let us move to the third technique that involves creating reserves in connection with an acquisition and then gradually releasing them into the income in future. Picture this. You have agreed to sell your business. Deal is set to be closed in 2 months. The acquiring company's management tells you not to record any more revenue during this time. A bit puzzled, you follow their instructions and stop recognizing any revenue. But here is the catch. By doing this, you are essentially giving your new owner a sizable and unwarranted gift because the 2 months of revenue you held back will now be counted as their revenue once the acquisition is complete. Let's look at the 1997 merger of the two companies, 3Com and US Robotics. They had different fiscal year ends, so a 2 month stub period was created right before the merger's completion. Interestingly, it seemed that the US Robotics decided to withhold a significant amount of revenue during this stub period, intending to make it available to 3Com after the merger was done. Here is the revealing detail. US Robotics reported only a tiny $15.2 million of revenue for these 2 months, about $7.6 million per month, which was a tiny fraction of $690.2 million they reported in the previous quarter, roughly $230 million per month. Instead of recognizing this revenue as a part of their regular business operation, it looked like US Robotics held back over $600 million of revenue. So, what did we learn from this technique? Not much, but the important thing that acquisitions are complex, and when companies engage in these kind of manipulation, they tend to make it more complex for us to understand. And delaying revenue recognition essentially gift the acquiring company with a held back revenue which becomes the part of their financial post acquisition. Let's move to the last and the fourth technique, recording current period sales in the later period. Imagine this last scenario. Management is having an outstanding year, hitting all the earnings targets for maximum bonuses. Sales are very strong, and they came up with an idea to ensure high bonuses for the next period too. Stop recording any more sale now and push them to the next quarter. It's a simple trick, and auditors might not catch it. Plus, the customers won't mind getting billed later. But even though it may seem harmless, this practice is dishonest and misleading to investors because it make it look like they are higher sales in the later period. More importantly, it shows that the management is making decisions not based on good business practices but are trying to make their financial reports look better for investors. So, what did we learn from this last technique? Delaying the recording of current period sales into future periods is a dishonest accounting practice that misrepresents a company's true financial performance and suggests questionable decision making by the management. With this, we come to the end of this exploration, and here is the final takeaway for you from this episode. Even successful and seemingly healthy companies may resort to manipulative financial tactics to present a more favorable image to investors. These tactics, such as delaying the revenue recognition, creating reserves, manipulating the accounting for derivatives, can mislead investors and violate accounting standards. The motivation behind these actions often revolves around meeting or exceeding investor expectations, maintaining the appearance of stability, or navigating the regulatory scrutiny. This learning underscores the importance of remaining vigilant and critical when analyzing a company's financial performance to make informed investment decisions. Thanks for listening to this episode. In the next episode, we shall discuss how expenses are manipulated for making the current period seem like a disaster to show beautiful profits tomorrow. Until then, keep learning, keep questioning, and keep exploring the captivating world of finance. Thank you and have a nice day.